Good afternoon. Welcome to today's webinar. My name is Samantha Peterson, and I am the founder and CEO of the Peterson Group, which offers a comprehensive range of unclaimed property consulting, compliance, education, and training services. Today's session is brought to you by FPS Trust Company. Today's webinar is timely given the recent changes with the Secure Act and IRS guidance released just last week related to withholding and reporting with respect to payments from qualified plans to state unclaimed property funds, as well as modifications to add distributions to state unclaimed property funds as a reason for self-certification for eligibility of waiver of the 60-day rollover requirement. During today's webinar and over the next half hour, we'll discuss the hidden risks inherent with the new requirements of the Secure Act for inclusion of part-time employees, as well as other government enforcement efforts, both federal and state, related to missing participants and uncashed checks from qualified plans. We'll take questions at the end of the webinar. I promise not to go too long. There's a lot of material to cover today, but we will reserve time at the end of today's session for questions. And by aligning the goals of plan sponsors, record keepers, and the various government enforcement agencies, we will also explore the safe harbor rollover guidelines as a solution to uncashed checks for missing and unresponsive plan participants. So what are some of the Secure Act requirements that you should be aware? So effective January 1 of next year, except in the case of collectively bargained plans, an employer maintaining a 401k plan is required to have a dual eligibility requirement under which an employee must complete either a 1 year of service requirement with the 1,000-hour rule or 3 consecutive years of service in which the employee completes at least 500 hours of service. Also, IRS Notice 2020-68, which was released on September 2nd of this year, just a little while ago, clarifies that all years of service, even years before 2021, must be considered for determining a long-term part-time employee's vesting in any employer contributions allocated to that participant's account. Although employers do not need to allow long-term part-time workers to contribute until 2024, keeping track of their hours must start next year, and that becomes effective on January 1 of this coming year. Tracking hours for part-timers under this somewhat complicated new rule poses greater challenges for employers. While many plan sponsors may outsource the function to their record keeper, this does not resolve the data issue inherent to this type of tracking. Thus, the new rule may create operational compliance errors for many plans. Where turnover of part-time employees is an issue, there will be more small account balances to deal with, whereby missing participants could become an even bigger problem for plan sponsors and record keepers. The issue of missing participants and these uncashed checks is already a huge issue for many plan sponsors and their record keepers, and the expectation is that it's only going to continue to get worse. Also, when a significant number or percentage of employees who are part of participating in a company's qualified plan are terminated and are no longer eligible to participate in the plan, a partial termination may have occurred in the eyes of the IRS. Said another way, the IRS could view the portion of the plan that covered the terminated employees as closed while the other portion remains active. Therefore, a company could be deemed to have a partial plan termination. The participants affected by the partial plan termination must become 100% vested upon termination. Plan sponsors should monitor their company's turnover rates to ensure they are not experiencing a partial plan termination, and if they are, ensure affected former participants receive proper distributions from the plan. Employers sponsoring a 401k plan as fiduciaries retain full responsibility and duty of being prudent and acting in the best interest of all plan participants. This includes safeguarding plan assets and following what is elected in the plan document so that participants receive the benefits they are entitled to under the plan. Plan sponsors retain the full support of a record keeper who essentially serve as the bookkeeper of the plan to track ownership and investment and what money goes in and out of the plan. Record keepers often have differing processes for administering outstanding checks, whereby their support to various plan sponsors may be inconsistent and ill-defined. But recognizing that record keepers play a significant role in administering this process, it is important for the plan sponsor and the record keeper to clearly define roles for locating missing participants and establishing procedures for uncashed distribution checks. As forced out distributions, also referred to as cash out distributions, are not eligible to be placed back into an ongoing ERISA 401k plan, the inherent problems with uncashed checks is there's no specific guidance from the Department of Labor to provide prudent procedures to safeguard these plan assets and ensure missing participants receive the benefits they are entitled to under the plan. Consequently, plan sponsors and record keepers struggle with how best to preserve a participant's benefit that goes uncashed. Unclaimed benefits often result from a missing participant or an unresponsive participant. And sometimes I'm often asked, well, what's the difference between the two? And the key difference in my perspective is the fact of whether the plan sponsor is aware if the contact information in the records for the participant is still valid. So indications of a missing participant might include returned mail by the U.S. Post Office or other carrier, commonly referred to as RPO, returned emails or bounced emails, and whether there's been any recent web account activity login or phone log activity for that participant. And often just an outstanding or uncashed distribution check can be an indication that the participant is in fact missing. To the contrary, the contact information may be valid per the records, but for whatever reason, the participant does not respond to communications. For example, some unresponsive participants may be deceased, a status which may be known or unknown to the plan sponsor. If the status is unknown, then the plan benefits are due to one or more beneficiaries who must be located. A plan sponsor needs to be diligent in monitoring and minimizing the listing of uncashed checks by performing address searches indefinitely if the participant remains unresponsive or missing, regardless of the balance of the uncashed check. The plan sponsor must use resources which often result in the plan incurring cost that continual communication with a missing and non-participant or non-responsive participant cost. So consistent with the DOL's position related to plan leakage, these costs are a drain on plan resources and capital the plan sponsor could be using to benefit the other participants that remain in the plan. So consequently, the dilemma of these missing participants and uncashed checks poses many risks to plan sponsors. I won't go through each and every one of these here, but I kind of listed them there for you on the screen. But I did want to just highlight a few that are very common and usually come up in discussions that I have with plan sponsors that are looking for a solution. First and foremost, the administrative burden that these missing participants and unresponsive participants and uncashed checks create. Many plan sponsors just desire to get these uncashed checks out of the plan. We're also aware that the DOL has put significant focus on auditing these plans to determine if the plan has policies and procedures for locating missing participants, which can be scrutinized and subject to penalties under audit. And lastly, there is concern from the group in terms of whether class action lawsuits could be on the horizon, especially when distribution triggers a taxable event, which we'll discuss in more detail. The IRS has made very clear when that reduces the participant's retirement benefit. So we'll discuss these risks in more detail, but I wanted to get your feedback on a polling question, okay? Who has the responsibility for handling uncashed checks and locating missing participants? If you'll take a moment, you should see a polling question available to you. If you will just respond to either A, plan sponsor, B, record keeper, or C, both, the plan sponsor and record keeper have a responsibility. So we'll give you a few minutes to address that. Okay, got a lot of good responses coming in here. Okay, all right, based upon the responses thus far, it looks about 75% of you believe it is the plan sponsor, where 25% believe it's both. In the eyes of the Department of Labor, I can tell you that it is the plan sponsor that the DOL will look to, but those that did answer both are not incorrect, because oftentimes the plan sponsors do rely upon the record keepers to help address the volume of these uncashed checks and address this dilemma that you run into. Okay, so we'll move along. Thank you for your feedback, by the way. Okay, so what's at stake? So the DOL estimates that each year $15 million in retirement plan distribution checks go unclaimed because plan participants or their beneficiaries have failed to cash distribution checks. The Government Accountability Office data indicates that between 2004 and 2014, separated employees left more than 16 million accounts of $5,000 or less in workplace plans, with an aggregate value of $8.5 billion. And note, these are pre-COVID unemployment statistics. Another interesting fact was TIAA, that's the Teachers Insurance and Annuity Association of America, estimates 30% of American employees have left a retirement plan account at their previous company. The figure rises to 43% for Gen Xers and 35% for Gen Yers. The problem is only expected to grow considering COVID-19 pandemic economic impacts, and the median job tenure for workers between the ages of 25 and 34 is less than 3 years. And that is according to data by the Bureau of Labor Statistics. While an exact figure is not known, the amount of unclaimed retirement savings in the United States has been estimated to exceed $100 billion. That is a lot of money at stake. So as I previously mentioned, the Department of Labor has not provided specific guidance for handling 401k uncashed distribution checks, yet the Internal Revenue Service, U.S. Treasury, and state unclaimed property programs continue to pursue the dollars left behind by missing and non-responsive 401k participants for small balance accounts and uncashed checks. So let's briefly review a little timeline here that I put together that demonstrates some of the legislative activity that has led us to this point. So I apologize for the small print on the screen there, but these slides will be made available to you after today's webinar. So with the Economic Growth and Tax Relief Reconciliation Act of 2001, Congress amended ERISA Section 401A31 to require plan administrators to transfer certain plan distributions into an IRA rather than in a lump sum payment if the participant failed to make a contrary election. This act provided for automatic rollover and force out or cash out provisions in most plans that are offered today. So in 2004, the DOL implemented rules to provide safe harbor protection for such transfers, but only for distributions less than $5,000. The Economic Growth and Tax Relief Reconciliation Act of 2001 stipulates that a vested balance between $1,000 and $5,000 must be rolled over into an IRA unless the participant made a contrary election. 10 years later, in 2014, the DOL issued Field Assistance Bulletin number 2014-01, which established that before making a distribution, the plan sponsor has a responsibility to contact plan participants for directions on how to distribute the participant account balance. Now, also during this time, you have to understand that there was a lot of litigation that was happening in the unclaimed property space, which is pretty much my background in my world, where the DOL and the courts consistently applied a broad view that ERISA was a federal preemption, which meant that any plan assets that were protected under ERISA were not compelled to escheat under state unclaimed property laws. So for a long period of time, there was really no direction for plan sponsors and record keepers in terms of what to do with these unclaimed checks or what to do with these missing participants, only because during that time the volume just continued to compound, because unfortunately advisors, especially us in the unclaimed property space, were advising that it's not an unclaimed property issue, so therefore there really was no emphasis or direction in terms of producing a solution for it. Well, that is until now. So once a plan fiduciary properly distributes the entire benefit to which a missing participant is entitled, the distribution ends the individual's status as a participant covered under the plan, and the distributed assets are no longer plan assets under ERISA. However, if the distributed benefit is reduced due to a fiduciary breach, the individual would still have standing to file suit against the breaching fiduciary under Section 502A2 of ERISA. So again, a lot of changes that were happening around this time, a lot of uncertainty. But again, what we're hoping to accomplish now is, as we are moving through some of the changes that the IRS and the DOL have proposed, that we do have a solution for plan sponsors. So moving along, again, this was all happening between years 2005 and 2014. So not until 2016, the DOL started a pilot program to address the issue of missing participants, which recovered about $326 million. Now, following on this success in 2018, DOL auditors began monitoring plan sponsors' failures to locate and contact missing participants and treat the failure to do so as a breach of fiduciary duty under ERISA, which can trigger substantial penalties. Among other penalties, the DOL may assess a civil penalty equal to 20% of the amounts recovered for the plan through litigation or settlement. As no surprise today, missing participants is a top DOL enforcement priority. Over the years, the DOL and courts have consistently applied, as I mentioned before, a broad overview of ERISA federal preemption and have consistently reached the conclusion that ERISA plan assets cannot be compelled to escheat to a state unclaimed property program. However, clear guidance for handling unclaimed retirement assets of missing and non-responsive participants is still lacking. Now, to address the need for federal action to clarify treatment of 401k savings, back in January of 2019, there was a GAO report issued that contained 3 primary recommendations. And those recommendations were: 1, that the IRS work with the Department of Treasury to clarify if transfers of unclaimed property retirement benefits to state unclaimed property programs are treated as distributions, and what the tax reporting and withholding requirements, if any, would be to apply to such transfers. The second was the IRS would work with the State Department and the Treasury to consider adding the transfer of retirement benefits to state unclaimed property funds from terminating defined contribution plans to the list of circumstances eligible for rolling over retirement benefits after the 60-day rollover period. And again, I'm going to emphasize in that recommendation that it was from terminating defined contribution plans. And then the third recommendation was that the Secretary of Labor specify the situations in which uncashed retirement plan checks from ongoing retirement plans can be transferred to state unclaimed property programs. So this is really around the time when there was a lot of emphasis around, should these uncashed assets or cash checks from these plan assets, be considered plan assets for transfer to these state unclaimed property programs as a way of, getting them out of the plan and giving some relief to plan sponsors in terms of how, this should be addressed and handled. And around that same time, the ERISA Advisory Council on Employee Welfare and Pension Benefit Plans, which we know as the ERISA Advisory Council, also began reviewing issues that employers faced in dealing with plan benefits payable to lost and missing participants. So you kind of got recommendations from both sides in terms of how the DOL and the IRS should handle, as well as what was coming from the plan sponsors from an advisory perspective. So when the ERISA Advisory Council got involved, again, this was around mid-2019, their stated purpose was to explore whether there are circumstances in which voluntary transfers of uncashed retirement plan checks to state unclaimed property funds advance the Department of Labor's goals of reuniting missing participants with their retirement savings. And again, I will put the emphasis on the word voluntary transfer. As a reminder that the DOL had been very consistent, as had the courts, in determining that federal ERISA preemption did apply. Therefore, state unclaimed property can't compel these assets to be reported, but a plan sponsor who wanted to voluntarily do so, there would be some guidance around it. So the council provided to the Secretary of Labor, Eugene Scalia, the following recommendations. The first being to make it clear that uncashed retirement plan checks are plan assets subject to ERISA, for which ERISA plan fiduciaries have a fiduciary responsibility, which are not subject to state unclaimed property laws on a mandatory basis. Thus, state laws are preempted by ERISA. The second was to clarify that a voluntary transfer of an uncashed retirement plan check to a state unclaimed property program constitutes a distribution of benefits for the purposes of ERISA. Once transferred, check is no longer a plan asset and all ERISA fiduciary obligations are extinguished. And lastly, the recommendation was to develop a safe harbor with respect to voluntary transfers of uncashed retirement plan checks to a state unclaimed property program. Under the safe harbor, an ERISA fiduciary is deemed to satisfy its ERISA fiduciary duties if it transfers uncashed checks to a state unclaimed property program that meets certain minimum standards to be developed by the DOL. And again, we haven't really seen a lot of response directly from the DOL, but we have seen here just in the last couple of months responses from other government regulatory agencies such as the IRS. So in response to these recommendations, mainly those to the IRS and the Department of Treasury, in 2019, the IRS published Revenue Ruling 2019-19, addressing the taxability of a participant's failure to cash a check that was issued in 2019, a distribution from a qualified retirement plan. So in that ruling, the IRS made it very clear that distributions from the plan, those uncashed checks, regardless of when it was cashed or not cashed, that it was a taxable event in that year. And then as recent as this month and effective on October 16th of this year, the IRS released Revenue Procedure 2020-46, which provides rules for waiver of the 60-day rollover requirement, providing a self-certification procedure for taxpayers to use in claiming rollover treatment. Specifically, it provides for a self-certification procedure, obviously subject to verification on audit, that may be used by a taxpayer claiming eligibility for a waiver regarding a rollover into a plan or IRA. It provides that a plan administrator or an IRA trustee, custodian, or issuer may rely on the certification in accepting and reporting receipt of a rollover contribution. Revenue Procedure 2020-46 also added to the list of reasons a taxpayer must have missed the 60-day deadline because of the inability to complete a rollover was that the distribution was made to a state unclaimed property fund. Federal income tax withholding rules were outlined in IRS Revenue Ruling 2020-24, which means the payment of an individual's accrued benefit from a plan, including both the amount sent to a state unclaimed property fund and the amount withheld, is a designated distribution. The plan sponsor is required to report that designated distribution and the federal income tax withheld on Form 1099-R for 2020. Okay, so again, the IRS in very recent weeks has ruled on this, but the issue still remains that the DOL has had a very clear, consistent position that they cannot be compelled, and this transfer to state unclaimed property funds would be done on a voluntary basis. So although the IRS has made it clear that distributions from a qualified plan are taxable in the year in which the distribution was made, that is the year in which the check was issued, the DOL and courts have again consistently applied that broad view of ERISA, federal preemption, and reached the conclusion that these cannot be compelled to escheat under state unclaimed property laws, as these uncashed distribution checks of missing participants are still plan assets protected under ERISA. And this actually came out in the study that was published back in January 2019 by the GAO, Government Accountability Office, where they reported that few assets from active retirement plans are being transferred to states as unclaimed property. And that's relatively consistent with the DOL and court's opinions, where they had indicated the amounts transferred to state unclaimed property funds primarily consist of funds related to non-ERISA plans for inactive or terminated ERISA qualified plans. So again, these, what's being transferred to state unclaimed property funds is not necessarily these missing and unresponsive participants of active ongoing plans, but those of non-ERISA plans or terminated plans. So presently, the states are exploring the concept of voluntary transfer of uncashed distribution checks, and that primarily is those checks less than $1,000. And as a fiduciary cannot provide any meaningful oversight of a state's unclaimed property program, the voluntary reporting of plan assets as unclaimed property may leave the plan sponsor vulnerable to risks of fiduciary breach. Now, further, given the DOL's lack of clear guidance on topic, before considering a voluntary transfer to state unclaimed property programs, plan fiduciaries and record keepers should weigh the risks of fiduciary breach and the potential for class action lawsuits on behalf of missing plan participants. Okay, so that specifically addresses state unclaimed property programs that right now, unless the DOL rules differently, which there's no anticipation that they will, that these plan assets cannot be compelled. It would only be a voluntary transfer on behalf of the plan sponsor to a state unclaimed property program. Now, it's not to say that the federal government has not also made efforts. I'm sure some of you have seen the bill that has been reintroduced by Senators Elizabeth Warren and Steve Daines. It's known as the Retirement Savings Lost and Found Act, which was proposed in the Senate on July 1 of 2020. Now, this bill, which Ms. Warren and Mr. Daines had first introduced in 2016 and again in 2018, so it's been floating around out there for a while, would use the data that employers are already required to report to create a database that would require plan sponsors to send lost, uncashed checks of less than $1,000 to the Department of Treasury. So from this perspective, you can kind of see that the states are starting to enact rules, requirements, or methods for voluntary transfer to states under their unclaimed property programs. In the meantime, you have the federal government also seeking ways to, get some access to these very large dollars that are remaining, especially for these $1,000 or less checks that go uncashed. So the issue with this new bill, though, and again, it's still to be seen where this goes, if anywhere, in the Senate. But this bill, unfortunately, omits steps outlining the responsibilities employers and plan administrators are to undergo to connect former employees with their neglected accounts, and directs the Labor Department, Treasury Department, and the Pension Benefit Guaranty Corporation to issue joint guidance no later than 1 year after enactment. So to me, that seems a little ridiculous, especially when we're sitting here when just the ability to define what the requirements are of a plan sponsor in order to locate, outreach, those efforts to find these missing and non-responsive participants, when the federal government can't even define that in the bill they proposed. So what's the real dilemma here? Okay, so if the DOL has ruled that these plan assets are protected under ERISA, are not to be mandated or required to be escheated under state unclaimed property laws, federal government really has no bill or legislation in place that would address it either. Companies are forced with the dilemma. What do we do? Do we do nothing, and these uncashed checks and missing participants just continue to accumulate, which is only going to get worse, based on some of the statistics that we first discussed, and especially in the post-math of a COVID-19 unemployment increase. So, the solution, I think that, is in line with what, the recommendations of the ERISA Advisory Council, as well as what the DOL has already been in support of, is a safe harbor rollover solution. Now, since the passage of the Economic Growth and Tax Relief Reconciliation Act of 2001, there have been several independent companies that have created a safe harbor solution that will accept rollovers of accounts under $5,000. But only a few companies meet the requirements for locating missing plan participants or have a process to address these uncashed checks associated with accounts under $1,000. As an alternative to voluntary transfer to state unclaimed property programs, which clearly trigger a taxable event, reduces the retirement savings of the participant, one could argue that common sense and fiduciary prudence would conclude that following the Safe Harbor IRA guidelines provides a solution that is already defined and acceptable by the DOL. A Safe Harbor IRA rollover solution is consistent with the DOL's position and aligns with the ERISA Advisory Council's recommendations. So again, aligning the goals of everyone, the plan sponsor, the record keepers, the IRS, the Department of Labor, as well as state unclaimed property programs, is really what has been the center of focus here in the coming weeks in light of these IRS rulings. So a safe harbor IRA rollover solution allows plan sponsors to transfer custody of small balance accounts, including eligible uncashed checks valued $1,000 or less, through a rollover to a low-cost IRA with a default investment that guarantees principal and interest to preserve the retirement benefits of missing plan participants. So the goal there being make, above and beyond efforts to locate these missing participants, establish contact with those unresponsive participants, and once those have truly been exhausted, then the rollover into a safe harbor IRA in order to preserve the retirement savings benefit of that missing participant is a better alternative to a voluntary escheat to a state unclaimed property program, where now you have to incur the additional administrative costs of withholding the tax, and worse yet, incur potential risk of class action when these missing participants come forward and realize that the majority of their retirement savings have been eroded through penalties and tax withholdings. So by aligning the goals of fiduciaries and these government enforcement agencies, a safe harbor IRA rollover provides the plan sponsor with access to enhanced technologies and methods for locating missing participants or their beneficiaries. I know a lot of companies may already be using queries against the Social Security Death Master File. That is a pretty common practice in the unclaimed property space, especially for insurance companies. It's actually a requirement. So, we work with a lot of companies to actually query those databases to confirm if any of the missing participants are in fact deceased, because if so, then, the location efforts can focus on the beneficiaries. But in addition to those benefits, the rollover also minimizes the risk of fiduciary breach. DOL audit penalties and the potential for class action lawsuits on behalf of missing participants who suffer individual loss of their retirement savings through a voluntary transfer to state unclaimed property programs is something that has to take, heavy weight in consideration in terms of how you resolve these uncashed checks for missing participants. So with the comprehensive solution, coupled with an unclaimed property program that is designed to address the concerns of the states, especially for distributions not eligible for rollover. What do you do with those? Such things as required minimum distributions and loan overpayments, those are not eligible for rollover. So again, this is where combining these technology solutions that are available to help plan sponsors to locate missing participants. Those technologies have been around for a while now, especially for companies that have large volumes of, checks or other types of properties where they're trying to locate individuals so they can reunite that money with them prior to reporting it to the state as unclaimed property has been a very common practice. So again, looking to combine these technologies and these service offerings to bring a solution to plan sponsors and their record keepers who are looking to reduce these uncashed checks and basically just get them out of the plan. And again, the lessened administrative burdens and things that come along with that. So again, from our perspective, obviously a safe harbor IRA rollover that preserves the benefit of those retirement plan assets is a far better solution, which again, we think is in line with what the DOL requires, would be a safe harbor solution for plan sponsors to consider. So I know that, puts us right on track, in terms of wrapping up today's session. I know I've covered a lot of information. I see a lot of questions have come through on the questions board. So with that, I'm going to stop talking and we'll kind of open this up to any questions that anyone would like to address as we wrap up. And I do see that many of you have requested a copy of today's slide decks. Yes, we will make these available following today's session. Once we get a listing of the participants and your email addresses, I will make sure that you get a copy of today's slides. Okay. Yeah, and I see that there's quite a few questions that are also coming in on the new rules around the Secure Act when it comes to the hours rule and determining when part-time employees can vest into the plan. We can also disseminate some additional information regarding that, because I see there's quite a few questions on that. So just know that we will definitely address those questions directly, because I'm just kind of looking through some of the questions here. They're kind of varying across the board, but I think you know, in the following information that we release, we can address many of these questions. Okay. All right. Well, if that is all of the questions that are coming in, I want to thank each and every one of you for taking the time to listen to today's presentation and giving us the time. If you have any additional questions or do want any additional information, please feel free to contact me directly. And I've also provided Mark Coppin's contact information as well. He and I worked together and we work very closely at FPS. So if you have any questions, feel free to contact us directly. Again, thank you for participating in today's discussion.